You know that old warning, past performance is no guarantee of future results? Well, what if the investment strategy that has worked for the last 40 years is about to, well, spectacularly fail? Today we're diving into a really bold and definitely contrarian forecast that says exactly that. And we're not talking about a little market correction here. This is a potential roadmap for a massive transition in the global markets, looking all the way out to 2026. This is about the end of an entire era.
Okay, let's just rip the Band-Aid off. This whole idea comes from macro strategist David Hunter, a guy with over 50 years of experience in the markets. And as you can see, he does not mince words. I'm calling for a global bust, accompanied by a big financial crisis. This quote, right here, is the anchor for this entire thesis. We're not talking about your garden variety recession. This is a forecast for a systemic event, the kind of thing most of us have never seen in our lifetimes.
So how in the world could we get from here to there? Well, we've broken this whole forecast down into a 6-part journey. First, we're going to set the stage and understand the end of an era. Then we'll look at what's predicted to come first, a final parabolic meltup. That's followed by the 2026 global bust. And after we've stared into that abyss, we'll pivot to the potential solution, a silver and gold hedge, what comes after the storm in the next commodity supercycle, and finally, wrap it all up with your contrarian investor playbook.
All right, let's get to the absolute core of this idea. This isn't about a normal business cycle, the ones that last a few years. The central argument here is that we are at the tail end of a massive 43-year super cycle. Think of it less like the daily weather and more like the entire climate changing. Since the early 80s, our financial climate has been one of falling inflation and falling interest rates, and that has been an incredible tailwind for stocks and bonds. This forecast argues that this long, beautiful summer is about to end in a historic storm.
This timeline really lays out the whole story, doesn't it? It all kicks off back in 1982. The Fed chair back then, Paul Volcker, did the unthinkable. He jacked up interest rates to crush the runaway inflation of the 70s. That single act started a disinflationary trend that defined the next 4 decades. As rates fell, year after year, it just got cheaper and cheaper to borrow money, fueling this epic multi-decade bull market. And even when we hit that massive speed bump in 2008, what did we do? We just doubled down. Central banks came in with a fire hose of money, which just pushed the cycle into its final, most extreme phase. And now the argument is we're at the end of that road, and the whole thing is set to come crashing down around 2026. But here's the crazy part. Before the bust, there's a boom. This is the first act of the drama, a final, absolutely explosive rally. Hunter calls this the parabolic meltup. And when we say parabolic, think of a chart that stops going up at a nice, steady angle and just goes vertical. It looks like a rocket launch. It's that final, euphoric, this time it's different phase of a bull market. And according to this thesis, it is also the most dangerous. Now, take a deep breath and look at these numbers, because this is where the forecast gets really wild. S&P 500 at 9,500, the NASDAQ at 32,000. I know, these figures sound completely unhinged from reality, and that's kind of the point. The theory is that the final stage of a supercycle isn't driven by rational things like companies' profits. It's driven by pure, raw market psychology, a giant final wave of speculative cash just crashing into the market. So what on earth could be the fuel for that kind of rocket ship? Well, according to this idea, it comes down to 2 really powerful forces. The first is something called institutional capitulation. So imagine you're a big shot fund manager. You've been cautious. You think things are overvalued. But the market just keeps going up. Your clients are calling you. They're angry. Your boss is nervous. Pretty soon, the fear of missing the rally becomes way bigger than the fear of a crash. So you give up. You capitulate. You just buy. That wave of big money creates this feedback loop that sucks in everyday investors who are suffering from a terminal case of FOMO, the fear of missing out. And that combination could be explosive. But what goes up, especially when it goes up vertically, must come down. This melt-up is just the appetizer for the main course, a devastating, global deflationary bust. It's the brutal, inevitable hangover after the wildest party in history. The higher we go, the further we fall. And again, just to be clear, we're not talking about a normal recession. This is a forecast for a full-blown crisis. So what's the ticking time bomb here? What's the core problem? Well, it all comes down to one absolutely staggering number, $330 trillion. That's the estimated pile of global debt. To put that in perspective, that's nearly 4 times the size of the entire global economy. For decades, we've been fueling growth by borrowing from the future. And that has created a system that is incredibly fragile. It's like we've built the world's tallest skyscraper on a foundation of sand.
It doesn't take much to bring the whole thing down.
You might be thinking, hey, we survived 2008, we'll be fine. But this slide shows why this time might be different. The 2008 crisis, as bad as it was mostly contained. It was about too much debt in the US housing market. This time, the theory goes the debt is everywhere. In governments, in companies, in households, all over the world. But here's the real kicker, the central bank response. In '08, they rode to the rescue almost immediately. The prediction this time is that they will hesitate. They'll worry about causing more inflation. And in a financial crisis, when the house is on fire, hesitation is the last thing you want.
So, what does a crisis like this actually mean for your portfolio, for your 401k? Well, the forecast calls for a peak to trough decline of around 80%. Yeah, 80. As you can see on the chart, that is way worse than the 2008 crash. We're talking Great Depression levels of wealth destruction. And the math of a drop like that is just vicious. If you have a $100,000 portfolio, an 80% drop leaves you with $20,000. To get back to even, you don't need an 80% gain. You need a 400% gain. For most people, that's game over.
Okay, deep breaths. That was a lot. So if that's the problem, what's the solution? How do you even prepare for a scenario like this? This is where the playbook shifts from playing defense to going on offense. The idea is to turn to hard assets, real things, and specifically precious metals, like silver and the companies that dig them up. This is all about preserving your capital. So why silver? I mean, why not just gold? Well, according to this thesis, silver is this unique two-for-one asset. On the one hand, yes, it's money. It's been a safe haven for thousands of years, and because its market is smaller than gold's, it can be way more explosive. That's why they call it gold on steroids. But that's only half the story. It's also a critical industrial metal. We literally cannot build the future, EVs, solar panels, AI data centers without it. And here's the kicker. We're already using more of it than we're mining. The market is in a structural deficit, creating a powerful tailwind.
So if you think silver is going higher, you can buy the metal itself, or you can buy the companies that mine it. And here's why that's so interesting. It comes down to a powerful concept called operational leverage. Let me break it down real simple. Let's say it costs a mining company $20 to pull an ounce of silver out of the ground. If silver is selling for $25, they make a $5 profit. Cool. But if the price of silver just moves up to $30, a 20% jump, their profit doesn't go up 20%. It doubles to $10, a 100% increase in profit. That is the explosive power you can get from the miners.
Now, the idea isn't to just throw a dart at a board and pick one stock. It's about building a small, diversified portfolio of these companies. You might have a high-risk, high-reward pure play like Hecla Mining to get maximum exposure to the silver price. Then you could balance that with a larger, more diversified producer like Pan American Silver. And for stability, you might add a company like Wheaton Precious Metals. They have a totally different, lower-risk business model called streaming, which gives a much more predictable cash flow. It's all about layering your bets. But here's the thing. The bust isn't the end of the story. Not even close. In this framework, the global depression is actually the catalyst for what comes next. It's like a massive forest fire. It's destructive, sure, but it also clears out all the dead wood and makes way for powerful new growth. And that new growth is predicted to be a massive, inflationary commodity supercycle. And this slide shows exactly how that's supposed to happen. Step 1. The bust triggers a crisis so big that the whole system is on the verge of collapse. Step 2. With their backs against the wall, governments and central banks have no choice but to act. Step 3. They print money, and I mean a lot of money. Amounts that make 2020 look like a rounding error. We're talking a predicted $20 trillion from the Fed alone. And step 4, that tidal wave of cash floods the real economy, igniting a powerful, long-lasting inflationary fire. In this new inflationary world, the value of everything real gets repriced. I mean, look at these potential long-term targets for hard assets. Gold at $20,000, silver at $500, oil at $500 a barrel. But it's so important to understand this. It's not really about gold getting more valuable. It's about the dollar in your pocket getting way, way less valuable because of all that money that got printed to fight the bust. So after all that, let's bring it home. What's the single most important takeaway for you, the investor? It really boils down to a fundamental shift in mindset. The core message is that the playbook that made people rich for the last 40 years isn't just outdated. It could be flat out dangerous in the environment that's coming. For basically our entire investing lives, the winning strategy has been buy and hold. Just buy an S&P 500 index fund, be patient, and let time do the work. It was simple, and it worked. This forecast argues that the age of set it and forget it is over. The new mantra is preserve and rotate. Job number 1 is just surviving the bust with your capital intact. Job number 2 is being nimble enough to rotate out of what worked in the past and into the assets that are predicted to lead the next cycle, hard assets and commodities.
And let's be crystal clear about the goal here. This is not about being a genius who perfectly times the market. Nobody rings a bell at the top or the bottom. The real strategic goal is much simpler: survive. If you can preserve your capital through the bust, you'll be one of the very few people with cash on hand to scoop up the generational buying opportunities on the other side. In this new world, playing defense isn't just about not losing, it's the ultimate form of offense.
And that brings us to the final critical question. For the last 40 years, the market has rewarded patience. It has paid to just be passive and hang on. But if this contrarian forecast is even remotely accurate, the next 10 years might reward something completely different: preparation. It really forces all of us to look at our own portfolios and ask a simple but profound question. Are we invested for the world that was, or for the world that might be just around the corner?